Debt consolidation is a financial strategy that can change lives, offering a way out for those drowning in multiple debts. But what exactly is debt consolidation and how does it work? Imagine this. It's late at night and you're sitting at your kitchen table, staring at a pile of unpaid bills, credit card statements, overdue loan notices, medical expenses. Everywhere you turn, there's another demand for money. You feel trapped, suffocated by the weight of mounting interest rates. And no matter how much you pay each month, the balances never seem to go down. You're not alone. Millions of people face the same struggle, overwhelmed by debt that keeps growing due to high interest rates and scattered payments. But what if there was a way to simplify it all? A way to roll multiple debts into one manageable payment with a lower interest rate. That's where debt consolidation comes in. Debt consolidation is a financial strategy that combines multiple debts into a single loan or structured repayment plan. Instead of juggling several payments with different due dates, varying interest rates, and different lenders, you simplify everything into one monthly payment. This can make it easier to manage your finances, reduce stress, and save thousands of dollars in interest. But how does it actually work? And more importantly, is it the right choice for you? In this video, we'll take a deep dive into debt consolidation. What it is, how it works, different methods available, the pros and cons, common mistakes to avoid, and expert tips on staying debt-free after consolidating. We'll also share real-life success stories of people who used debt consolidation to regain control of their finances. So, if you're struggling with debt, make sure to watch until the end because this information could change your financial future. And if you find this video helpful, don't forget to like, subscribe, and turn on notifications so you don't miss any future financial tips. Now let's break it down. Debt consolidation works by taking multiple high-interest debts, such as credit cards, personal loans, or medical bills, and combining them into one loan with a lower interest rate. This can help reduce the overall amount of interest you pay over time, making it easier to pay off your debt faster. But debt consolidation isn't a one-size-fits-all solution. There are several methods available, and choosing the right one depends on your financial situation. Let's explore the most common debt consolidation methods in detail. First, there are personal loans for debt consolidation. This is one of the most popular methods, especially for people with good credit. You take out a personal loan with a lower interest rate and use that money to pay off all your existing debts. The benefit? You're left with just one fixed monthly payment, often at a much lower interest rate than your credit cards. However, if you have bad credit, you may not qualify for a low enough interest rate to make a significant difference. Next, we have balance transfer credit cards. Many credit card companies offer 0% APR promotional periods for 12 to 24 months. This allows you to transfer all your high-interest balances onto one card and pay it off without accruing interest. But there's a catch. If you don't pay off the balance before the promotional period ends, the interest rate can skyrocket to 20% or more, leaving you in an even worse financial position. Another option is a home equity loan or a home equity line of credit, HELOC. If you own a home, you can borrow against your home's equity at a much lower interest rate than credit cards or personal loans. This can be a great way to consolidate debt, but it comes with a major risk. If you can't make the payments, you could lose your home. Then, there are debt management plans, DMPs. With this method, you work with a credit counseling agency that negotiates lower interest rates and structured repayment plans with your creditors. This can help you get out of debt faster, but some agencies charge service fees for managing your payments, so it's important to choose a reputable nonprofit agency. Now, let's talk about the advantages and disadvantages of debt consolidation. One of the biggest benefits is that it simplifies your payments. No more juggling multiple due dates and interest rates. Can also help you secure a lower interest rate, saving you thousands of dollars over time. In some cases, consolidating your debt can even improve your credit score by reducing your credit utilization ratio. However, there are also risks to consider. If you don't change your spending habits, you could end up in even more debt. Some debt consolidation loans come with hidden fees, and if you stretch out the repayment term too long, you could end up paying more in the long run. Home equity loans in particular can be risky. If you default, you could lose your home. Many people make mistakes when consolidating their debt. One of the most common mistakes is continuing to use credit cards after consolidating debt. This can lead to an even deeper financial hole. Another mistake is not creating a strict budget. If you don't control your spending, debt consolidation won't help in the long run. Choosing the wrong consolidation method can also be costly. Some people end up paying more in fees or interest because they didn't carefully evaluate their options. And finally, ignoring loan terms and hidden fees can lead to unexpected expenses. So always read the fine print before signing any agreements. So, how can you stay out of debt after consolidating? Here are some expert tips. First, stop using credit cards until you've paid off your consolidation loan. This will prevent you from falling back into the cycle of debt. Next, create a strict budget and track your income and expenses every month. Knowing where your money is going is the first step to financial stability. It's also important to build an emergency fund. This will help you avoid relying on credit cards in case of unexpected expenses. Whenever possible, make more than the minimum payment on your consolidation loan. The faster you pay it off, the less interest you'll pay overall. Let's take a look at a real-life example. Meet Sarah, a 42-year-old single mother who was struggling with $50,000 in credit card debt. She was making minimum payments every month but felt like she wasn't making any progress. Frustrated and overwhelmed, Sarah found herself at a crossroads. Month after month, she made the minimum payments on her credit cards, yet the balances barely seemed to shrink. The stress of juggling multiple due dates and high interest rates kept her up at night, making it harder to focus on work and family. She knew she needed a change, but the sheer number of options felt confusing and overwhelming. Determined to take control of her finances, she decided to explore debt consolidation. After researching various methods, she scheduled an appointment with a financial advisor to discuss the best course of action. The advisor took the time to understand her financial situation, reviewing her debts, income, and expenses. After careful consideration, Sarah chose a debt management plan through a non-profit credit counseling agency. This decision proved to be life-changing. With the help of the credit counseling agency, Sarah's creditors agreed to lower her interest rates and eliminate certain fees, making her debt more manageable. Instead of paying multiple bills each month, she now had a single, structured payment that fit within her budget. The agency provided her with financial education, teaching her how to budget effectively and avoid falling into the same debt trap in the future. Though it required discipline and patience, Sarah stayed committed to the plan, gradually seeing her debt decrease. What once seemed like an impossible burden now felt like a challenge she could overcome. In just 5 years, half the time it would have taken without consolidation, she paid off her debt completely. More importantly, she developed better financial habits, ensuring she wouldn't find herself in the same situation again. Debt consolidation can be a powerful tool for those struggling with overwhelming financial obligations, but it's not a magic solution. Success requires financial discipline, commitment to a structured repayment plan, and a willingness to change spending habits. If you're dealing with multiple debts and high interest rates, consolidating your loans could be a step toward financial freedom. However, it's crucial to research all options, compare interest rates, and choose a method that best fits your financial situation. The ultimate goal isn't just to combine your debts, it's to break free from the cycle and build a stable financial future. If you found this video helpful, hit the like button, subscribe, and turn on notifications for more financial tips. Have you ever tried debt consolidation? Share your experiences in the comments below. Your journey could inspire and help others. Thanks for watching, and we'll see you in the next video.